Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 3rd of August. Hope you're all doing well. I haven't made these weekend videos for a couple of weeks, but I'm back now, and yeah, let's get into it. So, looking at the next week from trading economics, and it says here next week investor attention will remain focused on President Trump's trade war following the announcement of sweeping tariffs on August 1st. In the US, important economic data releases include the ISM services PMI, trade balance, factory orders, and the preliminary estimate of Q2 productivity and labor costs. Globally, monetary policy decisions are expected from the Bank of England. Other key data include trade and inflation for China, retail sales and producer prices for the Eurozone, factory orders, industrial production and trade figures for Germany, trade and PMIs for Australia, trade and employment for Canada, and inflation from Switzerland. So, a few things going on this week that may drive the market. So, looking at the market, overall, from a risk sentiment perspective, risk on, risk off. Risk on meaning traders are looking at putting their money into more higher yielding assets, looking to take a bit more risk. Risk off is more being defensive, and looking at safe haven flows. And the VIX in the top left hand corner is as a measure of risk sentiment as well as volatility. And 20 is seen as a bit of a line in the sand where investors are a bit more risk neutral. So if you zoom in a little bit, we can see that we've kind of popped up above the 20, which means that, volatility is increased, and there could be the potential for, flows to move, investors to move their flows into safe havens, right? And really, the reason for that would be more to do with probably maybe some tariff uncertainty, or the potential for the US to go, well, there's some US data which we'll get into, which was really kind of poor unemployment. But when we're looking at risk sentiment, you can look at the front pages of the major publications like Bloomberg, Reuters, and the Financial Times. And if there is major, risk off sentiment, and there's a theme in the market, a narrative in the market, then normally the major publications will be all in unison with that theme, right? But if you can, you see here, Bloomberg, it says, Denmark's economy runs on Novo, talks about Trump tariffs, long COVID, Ireland's budget risks overheating the economy. Uh, Reuters have got India to maintain Russia oil imports. That's their main um, story. Tens of thousands of pro-Palestinians march over Sydney Harbour Bridge. And then you've got the Financial Times, European bank shares hit the highest level since 2008. So really a mismatch of stories, which means there's no real financial theme to the market. So in terms of a risk off scenario, I don't see why there would be any kind of, there's a risk off theme, but we do have, volatility increasing, that is for sure. Risk off would also mean that, or typically would mean that the stock market would, start to sell off as well. But in this case, the stock market is selling off. Right, it's selling off, but again, we need that kind of theme and a narrative, and it's all really about the why. This could just be profit taking going on. The stock market has been making, higher highs, and all new highs. So until we really kind of find out the reasons why, I would say this is more probably driven by the recent non-farms data, which we'll get into as well. So the dollar, selling off quite a bit on Friday. Gold is up from Friday as well, and you can see bond 2-year treasury yields is down. 2-year treasury yields is usually a reflection of interest rate expectations, but also risk as well. And investor confidence in government debt. So, but this is more driven, I think, by Friday's non-farm news, which we will get into pretty much right now. So, Looking at the currency summary report, something I thought I'll just introduce. This is something that the members have got access to in these weekend's videos. I'm only really going to be covering the major currencies, so the dollar, the euro, the yen, and the pound, the Canadian dollar, Australian dollar, New Zealand dollar, Swiss franc, for really the members. But the US dollar at the moment, yeah, kind of have a sell bias in terms of future central bank policy. There's now an 80% probability of a cut at the upcoming meeting. Before the meeting, it was the probability of a cut was actually quite reduced. But pretty much the summary of the analysis is that the sharp labor market weakness and the US payrolls grew by just 73,000 in July, and prior months were revised down by nearly 260,000. 3-month average job gains are now just 35,000, the weakest since the pandemic. Rising unemployment and weaker participation. The unemployment rate rose and labor force participation fell to 62%, its lowest in nearly 3 years. Prime age participation also dropped, likely impacted by immigration restrictions. Muted wage growth and long-term joblessness. So wage growth has largely stalled, with average hourly earnings rising by 3.9% year on year. Long-term unemployment rose to its highest level since late 2021, and the market reaction to all that and the Fed implications is that the Treasury yields and the dollar fell as the markets increased bets on a Fed rate cut in September. So again, we look at Treasury yields, right, fell, right? 2-year Treasury yields, and when we look at the dollar index, equally weighted dollar index on the daily time frame chart, you can see on Friday pretty much there was a sell off, and really the equally weighted dollar index is just the dollar strength equally weighted against the euro, the pound, the yen, the CAD, the Australian dollar, the New Zealand dollar, and the Swiss franc. So we can see that did happen, and it says here that where was I? The Fed rates held steady this week, but made shift dovish amid softening labor data and persistent inflation concerns. Weak labor market data, rising unemployment, and softer wage growth increased the likelihood of Fed rate cuts, pressuring the dollar. So the impact on Fed policy, which is really what drives currencies, central banks policy. The report puts downward pressure on interest rates, aligning with the dovish view within the FOMC. While Powell previously cited a solid labor market, this data may prompt a revision in tone, increasing the probability of a September rate cut, which it actually has done. Right, if you go to the CME Fed Watch tool, you can see here that before the day, when was it? A week ago, it was at 61.9%, and now it's increased in terms of a cut to 80.3%. So the market has to obviously price in the probability of a cut due to the data. So ultimately, we're looking at my bias is really to get short on the dollar, at least for now anyway. Not saying the dollar's going to sell off drastically, but for now, any pullbacks I think on the dollar index should be looked at as a selling opportunity. So all you would do is you would go to a pair that you want to be a buyer of, and the pair that you want to sell, that sell the dollar. So for example, we'll look at the euro next. If you want to be a buyer of the euro and a seller of the dollar, then on the euro dollar pair, what you're looking for is a pullback on the dollar index, right, to a bit of a cheaper area, to look for to confirm that kind of sell, right? So you want the dollar to be on the expensive side, you want the euro to be on the cheap side, and then when you're looking to buy the euro dollar, you know that you've got that value on your side in the background. So dollar for me is a sell overall. The euro, so the euro at the moment, they are really the central bank that are probably cutting the least this year. About 25 basis points worth of cuts probably priced in, 78% probability of a rate hold at the upcoming meeting. And really, the summary from the fundamental summary would be that the ECB rate cuts are likely complete. So the European Central Bank, the ECB, is signaling an end to its rate cutting cycle, with President Christine Lagarde hinting at a pause in July, which they did, and markets pricing in minimal further easing, around 15 basis points right at the time. Euro supportive trade deal, a new EU-US trade deal removes a major downside risk for the Eurozone, allowing the focus to shift back to monetary policy differentials rather than trade tensions. Rate differential dynamics favor the euro. The Fed and the Bank of England are expected to cut rates more aggressively versus the ECB, right? And that's the key, making euro relatively more attractive. And positioning reset. Recent euro weakness is attributed to the unwinding of long positions following the trade accord, but analysts see this as temporary, expecting the euro to resume strengthening. And analyst consensus turning bullish. Institutions like Deutsche Bank, Morgan Stanley, and Brown Brothers Harriman are aligned with a bullish euro dollar outlook, citing policy divergence and improving Eurozone resilience. And so, with all that being said, I do think that the euro is a buy. So, again, if you were looking at buying the euro, this pull back to this demand zone would have been the opportunity to look to buy the euro, right? So on Thursday, you had the euro was on the cheap side. If you were looking at fundamentally why you should be buying the euro, and at the time, of course, nobody knew that the dollar was going to have such bad news. But let's say, for example, you anticipated that the dollar index was, on the expensive side, right? So that aligns with why, if we're looking at the euro dollar quickly, why you would have looked for a potential buy around here, right? So you're looking for a expensive dollar, a cheap euro, right, index, right? So this is the euro index here. And then when you go to the euro dollar pair, you're looking for a buy here. Now, I'm not saying that the euro dollar was a buy, in fact, because at the time the dollar was actually considered a buy until the data proved otherwise on the Friday, right? But that's just an example of what you're looking to do as confluence when you're looking at the indexes and looking at trading the pairs, right? You don't want the pairs to both be expensive or both be cheap. You need the one that you want to be a buyer of to be cheap, and you want the one you want to be a seller of to be expensive. So heading back to the euro now for me I mean, it was always a kind of a buy. It's been a buy over the past few months anyway. So just a pullback. If you can get a cheaper euro on a pullback, and as long as the fundamentals support that pullback, then you're looking to buy the euro for cheaper. Um, Japanese yen. So the Japanese yen, you've got the summary really is that the Bank of Japan holds rates steady. The Bank of Japan maintained its its base interest rate at 0.5% in July, signaling continued data dependency and cautious policy amid persistent political uncertainty, yen weakness and policy tolerance. Bank of Japan downplayed concerns over the yen's decline, stating it isn't deviating much from expectations, a remark seen by markets as permissive by further depreciation. Political instability undermining Bank of Japan policy. The ruling LDPK coalition lost its upper house majority in the July 20 elections, compounding the prior loss in the lower house and creating headwinds for fiscal and monetary coordination. A delayed rate hike expectations, and analysts still anticipate hikes in October 2025 and April 2026, but political gridlock may delay the timeline, although some banks, for example ING, see inflation becoming a primary driver that could push the Bank of Japan to hike sooner. The Bank of Japan's tolerance for yen weakness, coupled with heightened political risk and lack of immediate tightening, adds downward pressure On the currency, despite medium term hike expectations, markets perceive the dovish intent in the near term and the impact on the Bank of Japan policy path. The Bank of Japan is caught between inflation pressures, which warrant hikes, and political instability, which argues for caution. This adds a dovish short term bias, but does not eliminate the medium term tightening path. So I'm pretty much got a short term sell bias on the yen. I really want the data to kind of support the yen buying at the moment, although they are hiking rates or seen as hiking rates. The political instability is really kind of preventing me from being a buyer of the yen. I think the yen is probably more of a short term sell. So when we look at the yen overall, and the yen index, equally weighted index, you can see the yen has kind of popped up really more to do with dollar weakness than any kind of yen strength. So I do feel that the yen is still probably likely to be a bit more of a sell. Fundamentally, can't really find reasons to buy the yen, or compelling reasons to buy the yen. There's always going to be a reason. Like I said, you could look for potential, the fact that they might potentially hike rates, but ultimately, um, I think the upside is likely to be a bit more limited and capped. Like I said, really, this move to the upside was driven by dollar weakness rather than yen strength, in my opinion. So if you are looking for short trades, you can probably look for short trades from here, or even if you wanted to look for short trades, probably from around there, because you've got a bit of a support there that could turn resistance in this area right there. But ultimately, I'll be waiting for a bit more of a pullback for me to get short on the yen. So that's really my bias. And then for the pound, the British pound, we have I've really got more of a sell bias with the pound. And the summary really is that the IOD's economic confidence index fell to minus 72% in July, sorry, 72 in July, the lowest since its inception in 2016. Business investment revenue and hiring expectations have all plunged. Policy and cost pressures. Firms are struggling with rising costs due to the national minimum wage and national insurance tax hikes. The upcoming autumn budget may introduce more tax increases, compounding uncertainty, stagflation risks emerging, which is never good for an economy. The UK is showing signs of stagflation with stagnant growth and sticky inflation, particularly food inflation, which rose by 4% year on year and could hit 6% by Christmas. Bank of England policy dilemma. While weak, economic data suggests room for rate cuts. Inflation persistence may limit the Bank of England to just one further cut, according to Pantheon Macroeconomics. Excessive easing risks undermining inflation control and credibility. The pound outlook is weakening. The combination of weak growth, persistent inflation, and rising fiscal risks, so debt, borrowing, bond sell-offs, has darkened the outlook for the pound. Further Bank of England dovishness could trigger renewed downside, tumbling business confidence, fiscal uncertainty, and the potential for deeper Bank of England cuts. Despite sticky inflation, increased pressure on the pound, especially against the dollar and the euro. So not too sure about against the dollar at the moment. That's probably just changed slightly, but definitely against the euro. So impact on the Bank of England policy path. The data increases pressure to ease monetary policy, but inflation constraints limit the Bank of England's flexibility. This creates a challenging stagflationary backdrop where policy support may be restrained despite clear growth weakness. So not great for the pound at the moment. So looking at the pound index, you can see that the pound is continuing to sell off. And in the group, I've been for the last few weeks, matter of fact, 3-4 weeks, I've been saying that the pound is likely to be a sell, and you can see what's pretty much been happening. So although we do have a bit of a demand zone and price may be reacting from that, for me, I'm going to continue to look for pullbacks into areas to look for sells, as I do think that autumn budget, unless there's any surprises, is probably going to hurt the UK economy rather than help it. But let's see what happens. So ultimately, as a recap, the dollar for me is a sell, in at least definitely in the short term to medium term. The euro is more of a buy. The yen is a bit more of a sell, although I can understand why you may look for buys on the yen as well. At the same time, maybe taking advantage of maybe some dollar weakness. But the pound, for me, any pullbacks are sell trades. So then it makes it easy to know which kind of pairs or pair you want to, get involved in, right? The euro is obviously the currency which stands out for me. So, looking at the euro dollar, right? If the euro is a buy and the dollar is really a sell, you're looking for pullbacks into an area to look for buy trades, right? The dollar yen, again, dollar yen, you could probably look for sell trades at the moment if you think the yen is. Uh, um, uh, uh, the better out of the two, maybe the stronger out of the two, because dollar sentiment at the moment, I think is definitely very negative. So if you are looking to get involved in this, although I'm not necessarily don't want to be a buyer of the yen, I would out of the two at the moment in the short term, the yen looks slightly better than the dollar at the moment. While the market prices in some rate cuts for the dollar, so pullbacks there. The pound dollar. Again, a bit more of a trickier one, so I wouldn't necessarily look to buy the pound or the dollar. But again, maybe the pound may look to strengthen just really more based on any kind of dollar weakness. But that doesn't, for me, it's not really a convincing argument as to the reason why I would want to buy the pound dollar. So personally, I'm staying out of this trade. The euro pound, yeah, definitely want to look for a long trade on this. So any pullbacks into a zone, right, buying the euro, selling the pound is going to be preferable. That's what I'm looking at. Euro yen, again, I would more look for buys on the euro than the yen. So again, any pullbacks I think should be decent buying opportunities if you get something on that. And the pound yen. So the yen looks like it's strengthening against the pound. So out of the two, probably looking for some sort of pullbacks on the buy, maybe the yen. Although just out of the two, maybe the yen is slightly the better candidate, better currency. To kind of buy. So yeah, that's really where we are with the major pairs. Looking at the metals, so gold, you would really look for if you're looking to sell the dollar, gold should be and silver really should be the buy. So if you've missed out on this buy, if prices pull back, and again the key is pullbacks, are going to happen. But if again prices pull back, but fundamentally you've got the dollar is still on the weak side. The market is still bearish on the dollar based on expected rate cuts. Then this is going to look like a really nice buy for gold, as well as any kind of increase in risk sentiment. Silver as well. If you missed out on gold, maybe that move to the upside. Silver looks like a decent candidate and may catch up to gold. It's lagging gold at the moment. So you can look for a buy in hopes that the negative dollar sentiment at the moment and data will eventually feed through to silver. And then looking at the indices, yes, we've had a bit of a sell-off on the S&P, but ultimately the sell-off over the past 2 days has only really been about 3%. So although it may look like it in terms of daily candles, this could just be a bit of profit taking. But again, the follow through would be more, I think, based on the actual narrative of any kind of risk of sentiment. And as I've kind of gone through the Bloomberg, Reuters, and Financial Times articles, it doesn't really there's no theme, no overall theme or narrative as to why this is selling off at the moment. So for now, there could be a potential buy here, especially with the Fed looking to cut rates. Normally cuts typically support stock indices. So this pullback could just be investors looking at the opportunity to look for buy. I'm not saying it's going to reverse here. It could basically break down and come down to the 6,000s. and that would represent a nicer discount, right? Maybe about a 7% discount on the S&Ps. But my bias would be more to the upside, especially now that the economic data isn't really um, uh, supportive in the US, and there is a rate cutting cycle potentially on the cards. Now, looking at some trades, and last time I made the video, managed to get involved in the dollar Swiss here. Managed to make some decent profit to the upside. Got stopped out on a trailing stop around here. You can probably go look at that video. And then last week managed to get in again on this. Only two positions. I'll scroll down to like the hourly. So saw an entry around these highs here. Um, Managed to enter right there on this at this time, and then wait for a pullback to 50% as well. Managed to get 50% pullback and buy pending order right here. Didn't get my 95%, but then what I did was took profit on the 50% pullback. So got myself to a profitable position, and then just really let the this trade kind of run. This I trailed my stop up to. Let me just delete this. Trailed this position up to just below here, matter of fact. So it was around the 1890s. I think it was somewhere around here, 1891. So managed to get trailed up to here, got stopped out on the data, but overall that trade actually ended up being about a 3-1, yeah, somewhere around about a 3-1 trade. So that was a nice trade. So I'm flat now on the on my trading account in terms of no trades, no new trades entered. So that's really all I've got for this week. But I'll be looking out for several trades, pairs, and yeah. So that's pretty much it. So have a great week ahead, and hope you found the analysis useful. Take care until the next video.